Well, shares of GameStop are popping this morning after meme stock oracle Keith Gill, also known as Roaring Kitty, posted a screenshot to the Wall Street Bets subreddit over the weekend indicating he has 5 million shares in the company and call options for 120,000 more. That total price tag of his stake is at least $115 million, although that would be before the stock started skyrocketing this morning. Gill is basically the man who started the GameStop story in the first place back in 2021. So as tends to happen on these days, other meme stocks, including AMC, Beyond Meat, BlackBerry, seem to be going along for the ride as well. Let's talk more about what it says about the mood of the markets with Adam Johnson, one of our regular guests and founder and author at the Bullseye Brief. AJ, it's nice to see you. What do you make of the GameStop story?
The last shall be first, John. I mean, it's just amazing. If there was any doubt as to whether or not speculation is alive and well, just there you go. GameStop. John, I wouldn't touch this stock if you paid me. I recognize it's up a lot, and the Reddit crowd, they're making more money probably than I am today because they're long that one and AMC and these other stocks that, again, I wouldn't touch. The problem with GameStop, John, is not only is it not making money, it's shrinking. Right? So earnings are negative. There are no earnings. Revenues will be down 5% this year. Why would you buy it? You look at a company like AMC, which I looked at as a fundamental investor at one point, and then I realized the AMC theaters, they don't actually own any of the real estate. They just rent theaters and then they charge ticket prices. So there's actually no backstop to the valuation of AMC. Again, there's no reason to own GameStop. I don't know. It's speculation and it just run amok. And John, it makes me kind of wonder whether we've learned anything over the past several years.
Okay, by comparison, Adam, let's talk about another hot stock story, Nvidia, the company's CEO talking over the last day about the AI chip cycle, once again exciting investors. We used a stat, stole it from UBS earlier, that more than a third of the S&P's rally this year is specifically tied to this one stock, and it's a stock in the past that you have liked. After the run-up that we have seen, how do you feel about it now?
Oh, I love it. I own it, and I think it's going a lot higher. And by the way, John, just to be clear, Nvidia is a company that I identified for my Bullseye subscribers a couple of years ago at 175. My first target was 475. I sold a little. My next target was 675. Sold a little. 900, sold a little. My current target is 1,200. I think that's too low. It's probably going to 1,500 or 1,600. So I think when you are fortunate enough to find a stock like this early on, and you do what I do, which is to buy 3 or 4% position, as that stock gets as it goes up, it gets larger as a percentage of assets in the portfolio. And I think you have to sell a little bit. But I still love it. I mean, I don't want to own any stock, whether it's Nvidia or any other, that becomes 15, 16% of my portfolio. That's just too big. But yeah, Nvidia is a beast. It is completely changing the paradigm for artificial intelligence, which is arguably changing the paradigm for business. So I'm certainly very comfortable still owning what is effectively an outsized position, because even as I continue to sell, it's still a very large piece of the portfolio. And it's just one of the AI stocks that I own, John. I own about 12. I wrote up a report for the Bullseye subscribers 2 weeks ago, the 24 best AI stocks. I own 12 of them. Nvidia is my largest position. Supermicro's another. Marvell, which is down, so you can come in and scoop that one. There's a lot about AI to like right now for fundamental reasons, unlike the GameStops and AMCs of the world.
We only have about 30 seconds left, AJ, but at the end of the day, would you say you're fully invested right now? I mean, obviously there's a lot of momentum behind AI in this morning GameStop, but what about the broader market?
Yeah, I'm fully invested, John. And as money comes in on the management side of my business, I deploy it. I don't want to say right away. That almost sounds sort of, like I'm being off the cuff about it. No, but I do put the money to work because I think we're going higher, John. Earnings are strong because the economy is strong. The economy is strong because employment is strong. That's the linkage, if you connect the dots, those 3 E's. It's very important: earnings, employment, the economy. So yes, I'm fully invested. I'm comfortable being long high quality fundamental names, but I would not touch any of those Reddit gamer stocks.
Welcome back for a look at some important stories in the world of business this morning. Let's go to Bloomberg's Divya Balji. She's managing editor for Breaking News Americas and joins us from the Bloomberg News Bureau in downtown Toronto. Divya, when this year began, the point was made by a lot of strategists that an unusual number of elections was going to be held around the world, and those elections had the potential to move markets. And indeed, we've had India and Mexico hold elections very, very recently in the recent days. And you're focused on the Indian stock market and the reaction to that election. Talk to us about that.
Yeah, Paul, I think this one was quite surprising when you compare it to Mexico. In India, exit polls were actually showing last week that the ruling party that Narendra Modi runs was expected to have a landslide victory. Now we're seeing that that's not the case, and even holding on to a majority is going to be really tough for him. Clearly in the background, they're trying to figure out if they can form a coalition of sorts to get this through. The number that we're seeing right now in terms of the number of seats they have is about 240 or 241. What they need is 272. Now that's really far from what they got, which was about 300 in 2019. So really, really different right now. That is hitting the stock market in a big way. It closed down about 5.9% today, and that's the Nifty 50, and that's not good. And I think what people are looking at is if you can't have a majority government putting forward policies that could potentially grow the economy or help certain companies is going to be much harder to do when you have to deal with other governments as well that might have their own plans in place. So I think right now what we're waiting to see is really the number of seats that the ruling party can actually get. Will they have to form a coalition government? What is that going to look like? There's a lot of uncertainty right now, and that's really what's hitting the stock market in India.
Okay, the biggest computing conference in the world is happening in Taiwan. It's called Computex. You're going to talk in a second about something that the Intel chief executive officer has said. Just before we get there, let's listen to and watch a clip from the CEO and what he said about the role of artificial intelligence in the semiconductor industry.
GFL stock did hit a record high today, and you can see it's still up around 3%. The Globe says the company is assessing two offers, one for its full business, another for its environmental services division. A group of infrastructure and sovereign wealth funds apparently teaming up here to make an offer, but the discussions are said to be preliminary and they may not lead to any transaction at all. Our guest is bullish on the stock and has said that there's a low probability, actually, of GFL going totally private. Michael Hoffman joins us now, Managing Director at Stifel. Thanks very much for coming on the show.
Thank you, Andy, for having me.
So is GFL stock cheap? Is that why people will be looking at a possible privatization?
Well, I think part of that privatization was driven by the existing private equity shareholders probably about a year ago when looking for were there options. Mm-hmm. And I think that's, the Globe talks about a banker being hired. I think that was about a year ago, having nothing to do with the current sort of climate. And we're looking at what their options were. How do you maximize shareholder value? In that context, the stock market has been discounting GFL due to its leverage and not giving them credit for the opportunity to organically delever the business, even if it was going to be a slow and steady process. They wanted it to happen faster, and they were penalizing them relative to their peer group.
The environmental services business, apparently that could be sold. Is that a big chunk of GFL's business?
So it's about 16, 17% of revenues and slightly less than that in profitability. The solid waste business is the higher margin business, and it's 83%. So we, Stifel hosts an annual firm-wide conference. We're in Boston. GFL was on a panel with me yesterday, and all these stories were breaking, and we came out and asked Patrick Dovigi, the founder and CEO chairman, what's happening, and his response was, "I'm not being paid to be complacent." And what it means, in my opinion, and I think we wrote this in our note, was, what's the best way to maximize shareholder value? And the sale of that business, very good business, number one market share in Canada, terrific footprint. It's not heavily weighted to energy. It's sort of a diversified end market strategy around industrial waste liquids. And it would be well bought by, there are a lot of interested parties. Assets like that have been trading between 12 and 16 times enterprise value. And so it would be something he would contemplate. He came right out and acknowledged that. And I don't think any advisors have been hired to do that, just to be clear. I think lots of people are giving him advice at the moment. I think the Globe's commentary is more about something that happened a year ago, and the existing private equity is looking for how to maximize shareholder value.
It is interesting. Sorry, I cut you off there, Michael. This services business is not the most glamorous. It's like drums of industrial waste, and it's used motor oil, but it's an essential service. And you could imagine that it'd be a steady earner.
Yeah, you're absolutely spot on, Andy. And I would tell you, like, the used oil business is a piece of it. What they are, and they have a terrific footprint nationally in Canada. About 90% of the revenues are in Canada, where they are the major player in collecting small quantities of industrial waste liquids, bringing them back into a wastewater processing facility, treating them, and then discharging and disposing. And they have a significant market share in Canada. It's a nice business. So your prior guest talked about a decent Canadian economy, no likelihood of a recession. You've got a good growth rate going there, and this business benefits from that.
And I imagine it's probably a tough business for rivals to enter, fairly capital intensive, and you'd have to build relationships, etc.
Relationships, permits, and if you thought about it as a scale of 1 to 10 just on size, they're an 8, and the next biggest one's a 3. So that's how big of a position they have. So it would be a hard thing to replicate. Buying it is the best way to do that. And private equity loves the environmental services business, but I think there's several strategics could be interested as well.
Broadly, even if there's no deal here, you think the stock is good value, GFL?
It is. They have one of the fascinating things, Andy, is this business is 17 years old. The peer group are 30. That just where they are in their life cycle looks just like the peer group 15 years ago. And yet the market keeps forgetting that this company has all of this self-help in front of it, automating their, the collection business in residential, going from rear load and 3 people on a truck to an automated side loader and 1 person, and you replace 2 trucks with 1, things like that. That self-help that drives operating leverage, price cost spread, all of those things are still in front of GFL, and if they drive that organically, they will naturally delever. And they'll get to the end of this calendar year and they'll be at 3.8 times levered. Another year they're at 3.2, 3.3. They're in investment grade territory. I mean, they start looking just like everybody else, and yet the market's not convinced that's going to happen. Prior to what was happening on Monday, say May 31st. The market was saying, I still don't believe you. And yet I believe that is exactly what the company is executing. And when they've got more evidence of it, the stock would have reflected what it's doing over the last 3 days.
Yeah, it's interesting. Too much debt has been a knock against the company, but you think they're going to be tackling that in fairly short order?
Well, and they've been steadily making progress. I mean, if people seem to forget that at the end of 2022, they were at 5.1 times levered. And at the end of 2023, they were at 4.3. And at the end of 24, they're going to be at 3.8. They're walking this down. It's just slow. And I think that's the end of the day. People are going, I want this to go faster. Well, fast means you have to do something like sell environmental services.
There's a look at what's happening in the markets today, and certainly the rise of AI has taken the markets by storm. And beyond the broader stock market story, we've seen the record run-up in stocks like Nvidia. Meantime, in the private markets, standout players are attracting investor attention too. Take startup Perplexity, which is standing out in a fast-growing chatbot market and already giving the traditional search engine business dominated by the likes of Google a run for its money. In fact, Nvidia CEO Jensen Huang is a big fan, and Amazon founder Jeff Bezos is an investor. Aravind Srinivas is Perplexity's co-founder and CEO, and he joins us now to talk more about the business. Aravind, thanks very much for joining us. We appreciate it.
Thank you for having me here.
Your business is very young, but it's caught a lot of attention, yes, on the investor side, but also on the user side. Very popular very quickly. What was the reason you wanted to get started on this in the first place?
I was really obsessed about search all the time since 2019, ever since I started reading a book on the founding days of Google. And my co-founders used to work on search at Bing and Quora. And so we all had this joint drive and passion for like reinventing the space. And we have been working in AI for many years. We saw the boom of large language models and generative AI, and we knew it could change every software there is. And it's almost like AI is eating all software, and the king of all software is consumer search in terms of the business, the scale of the business. So we wanted to go and try to see what we can do there, and that's what ended up becoming Perplexity.
And so for people who are using Perplexity, and some of them become very addicted users, and we talked about some very high-profile users as well, why do you think the approach that you took is catching on with users?
At the end of the day, people love products that are designed for them with what they want, obsession about the user experience. And Google used to be that when it came out, and that's why it disrupted Yahoo. But then Google ended up going the same path as Yahoo, where it became more of an advertising platform than a search engine. So people want search to work for them, not for the advertiser. And we had a new angle because we are able to provide direct answers to people instead of forcing them to sift through the 10 blue links, figure out which link is relevant to them, open it, have some pop-ups, ads scream at them, wasting their time browsing. Instead, you could just directly go and get an answer as if somebody did this whole browsing work for you, filtered the bad links, got only the good ones, took only the relevant paragraphs, and came to you with a synthesized Wikipedia article. That's what Perplexity does, except this happens in a second. So your time is saved, your knowledge is expanded, and people love that.
Arvind, obviously companies like Alphabet, the parent of Google themselves, have invested tremendously in AI. But I think, especially in the public markets, there's this constant question right now about whether that big shift for their business compromises their traditional search business. You obviously have a very strong view on that. But for people who are trying to figure out what happens to the traditional search business over the next 5 years, next decade, what do you think starts to happen?
Definitely the ad unit of links is getting disrupted. That's what's happening. Now, this doesn't mean the company Alphabet or Google is under tremendous risk. They have a diversified enough business right now with YouTube and cloud. And last I was aware, that itself is like $100 billion annual recurring business. So the company can still justify being a $1 trillion company. But the traditional ad unit of the link is definitely going to change as people stop clicking on them and start like directly interfacing with AIs and getting answers and like having AIs do stuff for them. So that is definitely going to get disrupted, and that is their highest margin. Even though they make a lot of revenue, that is the contributor for their margins. So Jeff Bezos has this famous quote, "Your margin's my opportunity." So that's what we're doing. Like, we're going after their margins. We might end up building a lower margin business, but who cares? As long as it's positive margins for us, we're happy. For them, any reduction in the margins is negative. So that's the innovator dilemma at play here.
Arvind, obviously you had a deep conviction around this and the ability to build something, but what's been your sense on how quickly you've grown, how adoption has played out, how you've attracted these high-profile investors, and of course you get constant questions around what's going to happen next with your business, where do you want to take things from here? How are you thinking about all of that?
I think I try to keep things simple. We have to grow, right? Without a critical mass of users, there's no business to build here. And we have to rethink what the advertising unit in our interface is without compromising on the truthfulness of the answer or the user experience. And there are great businesses that have balanced both subscriptions and advertisements really well. YouTube is one example. Netflix is another example. Spotify is also going along that direction. How to do that in a way that's sustainable, so that we don't have to be like every other generative AI company continually raising a lot of capital, but actually trying to generate enough money ourselves and use that to grow a user base in a sustainable fashion. And that's all the business challenges that we have. And growth would solve all our problems today. And that's what we are remain super focused on through our partnerships with telecom carriers like, Deutsche Telekom, SoftBank, SK Telecom. We have announced all these partnerships, and then we're going to partner with more companies. So we are really focused on like taking the Google playbook that they had in the late 90s and early 2000s, where they partnered with a lot of people for expanding their search engine, and then using that to build a great business model around it.
So just to wrap up before we let you go, because you've had that momentum, does it give you confidence that you can build this business for the long term? I guess, some people would say, do you want to go public at some point? But it sounds like you have all the building blocks to control your own destiny. So how are you going to think about that?
Yeah, definitely we want to go public. I think every AI company shouldn't always be like, I need to keep raising more capital. At some point, you do have to be serious about building a business. And when you do think there's a pathway to get it being profitable, then definitely try to be even more efficient. And that's the set of necessary milestones to achieve to go public. So I don't anticipate us going public in the next year or two, but is it on the cards 5 years from now? Definitely. We are still young as a company. We haven't even crossed 2 years since we started. So there's still a lot of time for us to like build a business, become efficient, and try to grow the business. And if we achieve all this, like I don't see any reason why we cannot IPO.